Hello and welcome to the Monday Futures Market Outlook for November 26, 2012. This is Patrick Serezna. For those of you that would like to try out our daily trading room where we're trading S&P futures, complimentary memberships are available on the website. During these videos, we use market timing strategies using intermarket analytics. For those of you that want to see that in print and us using those to find different ideas and so on in a newsletter format, please visit markettimingstrategist.com and learn about our new newsletter. As always, we start off with a chart of the US dollar index futures, and the US dollar hit that overhead resistance as it approached 82 level, where we felt that the risk-reward proposition of the US dollar was limited. And since then, the US dollar has come off of that high. At this stage, we look at the risk-reward proposition of the US dollar as relatively poor, not necessarily because it's imminent that it's going to crash, but rather that there's not very much opportunity at this point to make money for the remainder of the year here, while we do believe that there is vulnerability for it to trade back down towards the 79 level, down along those lows. At the same time, there's a reasonable chance it may still stay relatively range bound right in between these two focal points. Overall, we simply don't feel owning US dollars here is worthwhile. Next year, I want to take a look at the euro and recognizing that the euro, as it trades against the US dollar, is one of the key reasons why that dollar index had such a material reversal the other day. At this juncture, the euro has shown strength back to the 130 level, and certainly at this point is poised to potentially retest its highs. This certainly would keep pressuring the US dollar to consolidate. At this stage, we are not in the big picture very bullish the euro. But we do recognize there is room for the euro to strengthen, not only back up towards the September-October highs around 132, but if things really develop next year, we could see even highs as high as 135 in the first parts of the year. Next year, I want to take a look at the 30-year Treasury bond, and the Treasury bonds have been hovering near their highs. There's been a few days of consolidation, but we're going to be watching this very closely. It certainly would throw a bucket of cold water on the market's recent rally if we saw 30-year and 10-year Treasury bonds break to all-time new highs and dropping, obviously, the yields to all-time lows. We do believe that this is a material overhead resistance, and there's not a lot supporting that other than the fact that the Federal Reserve continues to want to maintain low interest rates. But will that be a catalyst for driving them to ever lower rates? That's something we're going to witness here on the short term. If this ends up developing to being a short-term flag, we'll see whether or not the bulls can gain enough momentum to break it to a higher high. But we like the scenario of bonds just being stuck in this range for the remainder of the year. Next year, I want to take a look at copper futures, and copper actually is poised to potentially have a retracement back up toward the highs. The correction that we've had over the last 2 months that saw copper go from about 385 down towards 340 has really at this point played itself out. We see some nice reversals coming in here. And so long as we have a strong euro, weak US dollar scenario, there's room for copper to strengthen back to 365, 370, even 380 on the upside over the next month or two. So we think that short-term selling is likely over for copper. Next year, we're going to take a look at crude oil. Crude is at a very interesting juncture. We may have seen the low. There's been an extended consolidation at that 85 level. And while there's always the chance a very quick drop lower and then reversal back up could occur, at this stage, if this is sort of like a rounding bottom, we could see crude oil try to break back up toward 100 into the tail end of the year, particularly if it's driven by broad commodity buying and rallying in copper and gold and all sorts of other commodities. If commodities in general come in favor, it could help the case for crude oil to strengthen. That brings us to wanting to look at gold, and we were suggesting all along that gold low would come in the 1650 to 1700 level. We were buyers of gold. We continue to be so. Recently, we saw that strength that allowed gold to push up towards 1750. Now, there's always going to be little pullbacks along the way, but we do believe it's at some point here within the next few weeks, we will probably see a retest of that 1800 level, and even potentially see gold position itself for even further gains. So finally, that brings us to the wanting to look at the actual S&P 500 and what the market is doing. We were suggesting that this market correction could naturally go down toward the 1320 to 1360 level, and we got a test directly into there. Now that that's come and gone, we've seen a material rally that has made it back all the way to 1400 level plus on the upside. At this stage, this is going to be a crucial level. It would be very constructive for the bulls to make it all the way back to 1430, but really what I'm going to be watching is going to be how the selling is contained during the next little give back. The markets never really, or it's very uncommon for them to just in a straight line blast higher. So there's going to be at some point a consolidation. We want to see the bulls really dig in and hold supports and don't let the bears get any momentum during selling. If that's the case, we can say with a high degree of confidence that was probably the swing low of the market, and that we are poised to have a good Christmas rally. So just looking at our key intermarket observations, we've changed the risk-reward proposition of the U.S. dollar to poor. It doesn't necessarily, again, mean that there's a massive amount of risk, but we certainly don't look at it as an asset class that will do you any favors here in the next little short period of time. The commodities, because of that, do actually finally look good, because copper and oil could roll up from these bottoms at the same time as gold continuing its trend high, push higher here. We've felt that this is a period where accumulating resource-based names has merit. While U.S. bonds remain in a very clean uptrend, we still cannot deny that up along the top end of these ranges, the risk-reward proposition of owning them is poor. While we haven't seen them begin really start selling or change the trend, we don't see very much merit in continuing to own them unless you're a shorter-term trader trying to scalp moves higher. At this stage, with the market correction having really played itself out clearly here, we do believe that U.S. stocks and global stocks represent a good proposition, and we are buyers of the market. That was your Monday Futures Market Outlook. Thank you for joining me.